Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Cave Creek, Arizona, where a mortgage is not a flip of the coin. So if you're looking to purchase or need to refinance, I would like to be your broker of choice as I have access to the lowest rates at the lowest cost in Arizona. And if you don't believe me, call me. Here is this week's market at a glance. Interest rates can't seem to catch a break. February was one of only a handful of months in the past 2 decades that resulted in a 0.5% mortgage rate spike. Despite hopes to the contrary, March isn't off to a great start either. It seems this rate drama isn't going to stop anytime soon. So why is that exactly? Well, it's because the plan in this case is to win the war on the pandemic. That's a multifaceted issue, of course. And the war is far from over. But most of the battles have damaging effects on rates when they're going well. At the most basic level, as COVID recedes, the economy improves, and a strong economy is the quintessential inspiration for rising rates. Inflation is a closely related concept to general economic growth because more demand in the economy results in higher prices, all other things being equal. Inflation is also an enemy of bonds and rates. Higher inflation, higher rates. There is a healthy debate right now as to how much inflation is actually driving the recent rate spike. Some give almost all the credit to fears of hyperinflation, while others aren't too concerned. The following chart puts things into context. The orange line shows how traders are actually betting on inflation, moment to moment. And the blue line is the actual 10-year Treasury yields. If inflation were the only driver, these lines would be moving up at the same pace. That's not to say that inflation isn't a relevant fear for rates. It certainly is contributing to higher rates in the slightly longer run, just not so much in the past month or so. Here's the same chart with a much wider view. As far as the Federal Reserve is concerned, any major inflation spike in the near term will be a temporary byproduct of COVID-related supply constraints and computational factors. Specifically, year-over-year numbers will soon be based on months in 2020 that had extremely low inflation. As an example, April 2020, the beginning of the real COVID fears, compared to April 2021, was always probably going to look pretty high. The Fed will continue to buy treasuries and mortgage-backed securities, MBSs, until they're confident their goals have been achieved, both in terms of inflation and the labor market. Fed Chair Powell reiterated that commitment yet again in a webcast during the Wall Street Journal's Jobs Summit on Thursday. But that stance is so well known that it was of little solace to those on the rising rate bandwagon. For some reason, some traders began speculating that Powell and the Fed would say or do something to bring rates back down a bit after several weeks of rapidly rising rates. That's not necessarily far-fetched, but the buzz was centered on an operation twist, a past Fed policy that involved selling shorter-term bonds and buying an equal amount of longer-term bonds. In doing so, the Fed could keep spending the same amount of money while putting more downward pressure on the longer-term rates that benefit consumers. Just one problem. The Fed has been really clear in saying that option is off the table. It was a possibility in late 2020, but they unanimously shot it down. Several Fed speakers reiterated that decision in more recent months. Moreover, in the past few weeks, as rates have been spiking, almost every Fed speaker has made some combination of the following point. The rate spike reflects the broad economic optimism and progress against the pandemic. Rates at these levels aren't currently a concern. In other words, rapidly rising rates are a logical byproduct of what's going on with the economy, COVID case counts, and vaccination progress. They're good news even if they're bad news for fans of low rates. Who doesn't want low rates? Powell stuck to the same script, and the markets had a bit of a fit. The following chart shows the Powell reaction along with last week's 2 other noticeable rate spikes, one driven by Europe and the other by a strong jobs report. Bottom line, rates have been rising for well understood reasons, even if the pace has been surprising to some. With the Fed basically endorsing the rate spike as evidence of progress, don't be surprised if the pace can continue to Well, it may surprise you. Turning to mortgage rates, specifically, the week ended with 30-year fixed rates right in line with their highest levels in nearly a year. Most mortgage rate headlines won't mention that because they're based on Freddie Mac's weekly survey, which has yet to catch up with the reality on the front lines, especially for refinance rates, which are a bit higher than purchase rates. The 2021 rate spike has been around long enough to be taking a visible toll on mortgage applications. Outright levels are still very strong, and there are other factors in play, of course, but the correlation is solid. Notably, rate spike looks like it had a bigger implications for purchase market, but past precedent suggests an even bigger supply of other factors behind that move. Purchases don't tend to be as nearly bothered by raising rates, nor do they tend to respond so quickly. So is there any hope? Can rates return to sub 3% levels at any time soon? Are they going to continue to move much higher? Be prepared for rates to be stubborn about moving quickly lower. The economy has a lot to look forward to. It will take time for some of the more economic bearish scenarios to play out in a way that helps rates significantly. If we see things improve in the near term, it would most likely result from behind-the-scenes trading motivations that have nothing to do with economic growth, inflation, or the Fed policy. In other words, they'd be largely technical in nature, and thus not something to plan for. How about stocks? If stocks fall, could that help bonds and rates? It can help to some extent, but I caution anyone against expecting higher rates to cause sustained selling in stocks, which in turn helps rates come back down. That was common at the end of 2018, but it certainly wasn't that simple. Moreover, the two time frames are different in several important ways. Now, will you be able to see stock prices and bond yields move like this? Yes. But that movement doesn't always mean that rising rates are hurting stocks. More importantly, the takeaway can change when we zoom out. So, is there any shred of hope? We all want hope, right? Is there any shred of hope? Absolutely. There's always hope. Rates only rise so much and so fast before the market corrects. While it's important to know how the new realities of the pandemic will affect the normal time and scope of such things, it's no less of a certainty. If you need a rate chart to help you put the super big picture into perspective, the past few decades of the 10-year yields is always a solid choice, as shown here. So that's this week's Market at a Glance. Thanks for watching, and if you're looking to refinance or purchase a home in Arizona, I would like to be your broker of choice. Until next time, take care and stay safe.